Hi, welcome to this tutorial. So in this today tutorial, we are going to discuss capital asset pricing model. So what is capital asset pricing model actually? The capital asset pricing model is used to measure the expected return from an investment. If you are looking from an investor point of view, that is expected return. Or if you are looking in a business point of view, it is the cost of capital. So practically both are same. If you are looking into an investor viewpoint, expect definitely you are getting for your expected return. Again, if you are looking from a business point of view, it is it is used to determine your cost of capital. So both are same. So this expected return actually is the cost of capital for the business. So practically the both are same. It is used to measure the expected return from an investment. If you are measuring as a business point of view, it is used to measure the cost of capital, especially the cost of equity. So I'll start with the formula for capital asset pricing model. So the formula is return is equal to risk-free rate plus beta into market return minus risk-free. This is the formula for capital asset pricing model. So let's look into this example. Just assume in a case the risk-free return is 6%. That means this risk-free, this 6% can get from a bank deposit. That means it is completely risk-free. And the market return, just assume it is 12%. And the beta, just assume it is 1.2% beta. So in this case, how you calculate the expected return? Risk-free, that is 6% plus beta 1.2 into market return divide minus risk-free. Risk-free 6%. So in this case, it is 6 plus 1.2 into 6. So that means 6 plus 7.2, 13.2. This is the expected return in this case. So what we are measuring actually, when we are analyzing this formula, so here any investor who making an investment would definitely who has to get the risk-free return, because it is the risk-free return, completely risk-free return in the economy. So this 6% he has to get plus the market risk premium. So if I'm making an investment, I have to get the risk-free return, that is 6%, plus the market risk premium. That means the premium to take this risk. Here there is a risk. The beta is 1.2. That means there is a risk in the stock. So I took that risk as a challenge. So what I get? I got 7.2% as a risk premium also. So my total return will be 6 plus 7.2, that is 13.2. So it is very clear now, the risk-free return plus market risk premium. This is the formula for market risk premium. So what is market risk premium? If I'm taking a risk, definitely I have to get extra premium return from that investment. That is market risk premium. So normally if you're not taking any risk, you will get 6%. Plus I have took a risk. So that is market risk premium. So I have to get that market risk premium as well. So in this case, I have to get these two, risk-free and plus market risk premium, that is 7.2, 13.2%. So this is the formula for capital asset pricing model. To evaluate the expected return from an investment or to measure the cost of capital if you are measuring the capital asset pricing model from a business point of view. Here one term what we mentioned is beta. So what is beta actually? Beta mean market volatility. That means if you are decided to invest in a stock, so how this stock is volatile to changes in the market. If this is highly volatile, market changes, the beta will be greater than 1. If it is similar to market changes, the beta will be equal to 1. If it is less volatile than the market changes, then it is less than 1. And if some stock is not related, this stock is not related with the market movement. It is independently moving. It is not volatile with the stock market movement. Then the beta will be 0. But in some cases, the opposite can happen. Sometimes the market moving upward, this stock will going to downward. Vice versa also. So if it is moving reversely or inversely, the beta will be minus 0. So we have discussed what is beta, what beta mean, how this stock is volatile with the changes in the market movement. So if the beta is greater than 1, which means this stock is moving greater than the market, is volatile than the market movement. Just assume if market move 10% higher, maybe this stock will move 12% higher. That means greater than the market movement. This stock is moving in the same direction, the greater than the market movement, then the stock beta will be greater than 1. If it is equal to 1 mean, suppose market is moving 10% up, then again this stock will also move the same direction at the same volatility. That means 10%. So in this case, the beta of the stock will be 1. If it is less than 1 mean, again it is moving in the same direction but not volatile like this. Just assume if market is moving 10%, this market movement can be up and down in any of these cases. If it is up 10%, just assume in this case, if the beta is less than 1, the stock is moving almost 8%, just assume for an example. That means less than this value, less than the market movement. Again, if it is 0, there is no relationship between market movement and the stock movement. This is no relation if it is in 0. Less than 0, if it is less than 0, then mean it is moving opposite direction. So if it is beta greater than 1, that means it is more volatile, and it is equal to 1, that means if beta is 1, it is almost in the same direction and same proportion. The market and the stock price is moving. If it is less than 1, that means that it is moving in the same direction but in a less proportion of the market movement. If it is 0, 0 means there is no relationship between market movement and the stock movement. It is 0. If it is minus or less than 0 means it is moving but in the opposite direction. Just assume if the stock price increased, the market is moving upward, then the same time the stock will go down. So this is about beta. Then we will move to security market line. Security market line. Security market line means it is the graphical representation of capital asset pricing model or the formula for capital asset pricing model. Just assume this is the return. This is beta. This is moving this direction and return is moving this direction. Here, just assume the 6%. This is risk-free return. Just assume if it is 6%. This is the risk-free return. Above this is the return, expected return. So what is the difference between this risk? This is risk-free return. This is the total return. So the difference between these two, that means this is called market risk premium. So that means this is actually the investors are getting to taking that risk. Anyway, this risk-free rate is always they can get from a completely risk-free investment. But he is taking the risk, that's why he is getting this market risk premium. So this is exactly the graphical representation of capital asset pricing model. This is security market line. So you can see this. This is the risk-free return, and the difference between the total expected return and risk-free, that is market risk premium. Market risk premium means what is actually an investor getting to buy for taking his risk. That is market risk premium. Again, beta and risk. Actually, there is a solid relationship between beta and risk. If definitely beta is higher, definitely the market, the security risk will also higher because it's more volatile to the changes in the market. So if the market get down, the stock can be more volatile and can be get down than the market movement. Again, there is a same proportion or same possibility for return as well if the market is moving in upward, The same, there is a good possibility to move this stock also upward. So this is the relationship between risk and return. That means it's if the beta is increasing, obviously the risk also increasing. If you selected a stock with the highest beta or a highest beta, definitely you are selecting a stock with the highest risk. If you are selecting a stock with a lower number of with the lowest beta, definitely you are selecting a stock with the lowest return. This beta, this is return. It's always in the same direction. If you are taking more risk, definitely the stock beta will be higher. If that means the stock, if you selected a stock with a higher beta, that means the stock have a higher risk. At the same time, if you selected a stock with a lower beta, at the same time your risk will also lower. So this is about the relationship between beta and risk. Again, same time the return also. If you are willing to take more risk, more beta and more, definitely you are expecting more return as well. At the same time, if you are willing to take only the lowest risk, then you have to choose a stock with the lowest beta, and you can expect lower level of return as well. So one more time repeating the relationship between beta, risk and return. If you have selected or an investor selected a stock with a higher beta, definitely he is selecting a stock with a higher risk. Same time, he can expect a higher return as well because he is selecting a higher risk. Before we already discussed the relationship between risk and return. If you are willing to take more risk in an investment, definitely you can expect more return as well. At the same time, if you selected or an investor selected a stock with a lower beta, definitely your risk also lower and the same time you can expect only the lower level of return as well. So what we discussed today is capital asset pricing model. Capital asset pricing model is a method to calculate the expected return or the cost of capital of an investment. So we already have discussed the formula for capital asset pricing model, the formula to calculate the expected return. There the risk-free rate plus market risk premium is the formula. Market risk premium, this is the formula for expected return. And what we discussed the beta, about beta and the different type of beta, if it is greater than 1, equal to 1, if it is beta equal to 1, less than 1, 0 and less than 0. Again, what we discussed that finally the relationship between risk, return and beta. So this is about today's discussion. If you have any doubt or you need extra clarification on any of these topics, please let me know on comment section. Thank you for watching this video.